Welcome back to Charged Alpha. I'm Hudson Thomas, joined as always by my co-host Lana Chen. In this segment, we're zooming out from the quarterly noise for a full company chapter.
That's right, Hudson. Before we dig into the latest earnings, let's make sure we actually understand this business. What it does, how it makes money, and what makes it competitively distinct.
Regeneron Pharmaceuticals is a fully integrated biotech company headquartered in Tarrytown, New York. It discovers, develops, and commercializes biologics targeting inflammatory conditions, eye diseases, and oncology.
The company was co-founded in 1988 by Leonard Schleifer and George Yancopoulos. Both remain deeply involved, Schleifer as CEO and Yancopoulos as Chief Scientific Officer, making this one of biotech's most enduring founder-led partnerships.
The crown jewel is Dupixent, a biologic targeting the IL-4 and IL-13 inflammatory pathway. It has been approved for atopic dermatitis, asthma, nasal polyps, chronic obstructive pulmonary disease, and other conditions, with more indications under review.
Dupixent generates roughly $14 billion annually through U.S. sales and royalties from the Sanofi partnership, which handles commercialization outside the United States. This collaboration is central to the entire Regeneron business model.
Eylea, an anti-VEGF therapy for age-related macular degeneration, was Regeneron's first major commercial win. It contributes around $5 billion annually, though biosimilar competition is increasing as key patents expire.
Gross margins approach 85%, which reflects the pricing power of biologic drugs with proven profiles. Research and development spending runs at roughly 30% of revenue, high by most standards but consistently productive.
A unique competitive asset is the REGN Genetics Center, one of the world's largest biobanks. Linking millions of genetic sequences to health outcomes gives Regeneron a drug discovery advantage that is genuinely difficult for rivals to replicate.
On the emerging pipeline, Regeneron is advancing trevogrumab, targeting obesity and muscle wasting. The obesity space is intensely competitive, but Regeneron's scientific track record in novel biologics gives it real credibility with clinicians and payers.
Vertex, AbbVie, and Biogen are among the closest large-cap comparables. Vertex has a durable cystic fibrosis moat. AbbVie is managing Humira biosimilar erosion. Biogen is navigating a challenging pipeline transition.
Regeneron does not pay a dividend. Capital goes toward pipeline investment and selective buybacks. A substantial cash balance provides flexibility to in-license assets or make targeted acquisitions without relying on external financing.
The Sanofi partnership de-risks global commercialization, but means Regeneron shares Dupixent economics. Whether the company eventually internalizes international rights is a strategic question that could reshape long-term economics meaningfully.
Dupixent growing at 20% annually, with multiple additional indications potentially ahead, suggests real runway remains. The core risk is whether the next platform can be built before Eylea erosion accelerates significantly.
Science-led businesses with durable franchises and recurring high-margin revenue tend to compound well. Regeneron fits that description, and the genetics engine provides a structural edge in finding what comes next.
Understanding that flywheel, from genetics discovery to approved drug to expanding indications, is what sets Regeneron apart from most in this sector.
That's the company chapter for Regeneron Pharmaceuticals. Now that we've got the full picture, let's get into the earnings.
Time to dig into the numbers. Let's go.
Regeneron just reported a Q1 2026 print that beat the street on every line, but the stock still went lower. Revenue up 19% year over year to $3.605 billion. EPS came in at $9.47 versus the consensus $8.89, a 6.5% beat. Yet shares dipped 2.9% to $7.06. This is Charged Alpha. Let's break it down.
Regeneron is a biotech major built on monoclonal antibody science. The company sits at roughly $73 billion in market cap and operates through two flagship franchises. Dupixent, partnered with Sanofi, treats atopic dermatitis, asthma, COPD, and a growing list of inflammatory indications. Eylea and Eylea HD treat wet, age-related macular degeneration and diabetic eye disease. Together, those two franchises drive the bulk of economics.
The platform behind the products is what investors really pay for. Regeneron's VelociSuite technology generates fully human antibodies faster than most peers, and the pipeline now includes cemdisiran for myasthenia gravis, garetosmab for FOP, fianlimab in melanoma, and Libtayo across oncology. Founder-led by CEO Dr. Leonard Schleifer and Chief Scientific Officer Dr. George Yankopoulos, the science culture remains the moat.
Let's walk the income statement. Total revenue for Q1 came in at $3.605 billion, up 19% from roughly $303 billion a year ago. Non-GAAP earnings per share was $9.47, up 15% year over year. The product mix is what tells the real story. It's a tale of two trajectories playing out inside the same income statement.
Dupixent global net sales recorded by Sanofi hit $4.9 billion, up 33%, or 31% on a constant currency basis. That is exceptional growth for a drug already at run rate scale. Label expansion into COPD and pediatric eosinophilic esophagitis is widening the addressable patient pool, and prescription volumes accelerated through the quarter rather than decelerating.
EYLEA HD, the higher dose, longer interval formulation, posted U.S. net sales of $468 million, up 52% year over year. Libtayo, the oncology asset, jumped 54% to $438 million. Both are growth engines that increasingly offset the drag from the legacy EYLEA product as patients migrate.
Now the harder number. Legacy EYLEA U.S. net sales fell 36% year over year to $473 million. Biosimilars are pressing on price, and patients are shifting to EYLEA HD or to competitor anti-VEGF therapies. Management guided that sequential EYLEA demand will fall mid to high teens in Q2 ahead of additional biosimilar launches in the back half of 2026.
Gross margin came in at the typical biotech 85.4% on a non-GAAP basis. Importantly, full year 2026 GAAP gross margin guidance was lowered to 77 to 78% because of a temporary manufacturing interruption at the Ireland facility. That guide down was the single biggest reason the stock dipped despite the headline beat.
The balance sheet is fortress quality. Cash and marketable securities totaled $3.1 billion. Total debt is $2.7 billion against equity of $31.3 billion. Net cash position even after capital returns. Free cash flow trailing 12 months was $4.08 billion. The board authorized a fresh $3 billion buyback on top of existing programs, signaling confidence in the long-range trajectory.
Analyst coverage skews bullish, but with notable post-print target cuts. The consensus is 10 buys, 3 holds, and 0 sells. The average price target sits near $854, meaningfully above the $706 trading level, implying roughly 20% upside if the consensus plays out. But several analysts trimmed targets after the call.
Wells Fargo's Mohit Bansal kept an equal weight rating, but cut the target from 825 to 800. Barclays' Eliana Merle held an overweight rating, but lowered the target from 923 to 917. The pattern across the desk is consistent. The Q1 beat is recognized, but the EYLEA biosimilar runway and the manufacturing margin guide down are pulling forward estimate cuts.
Valuation looks reasonable on forward numbers. Trailing PE is 17.8, and forward PE drops to 13.3 on consensus 2026 earnings of 5302. Price to sales is 5.1, price to book is 2.35, EV to EBITDA is 11.5. For a profitable biotech with a multi-billion-dollar pipeline, those are not stretched multiples by any reasonable framework.
The bullish narrative centers on Dupixent runway. If Dupixent compounds at 20% plus through 2028 on label expansions, the franchise alone supports the current valuation without giving credit to pipeline assets. Cemdisiran, garetosmab, and fianlimab all read out with FDA decisions or Phase 3 data inside the next 18 months. Optionality the street is not fully pricing in.
Beta sits at 0.4. Regeneron behaves much less like the broader market and much more like a regulated biotech, driven by trial readouts, FDA timelines, and pricing dynamics. That low beta is appealing for portfolio construction, but it also means stock-specific catalysts dominate the return profile. The next 18 months are catalyst-dense.
The bull case rests on 3 pillars. First, Dupixent label expansion. $4.9 billion in a single quarter at 33% growth is not a maturing drug. it's still scaling. COPD, prurigo nodularis, chronic spontaneous urticaria, and pediatric indications add years of incremental volume to a franchise already at run rate scale.
Second, pipeline depth. Cemdisiran NDA accepted for myasthenia gravis with a Q4 FDA decision. Garadosmab on priority review for fibrodysplasia ossificans progressiva with August target action. Fianlimab phase 3 data in metastatic melanoma upcoming. 3 potential approvals or readouts in 18 months gives investors multiple shots on goal beyond the current franchise.
Third, capital generation and return. $4.08 billion in trailing free cash flow funds a fresh $3 billion buyback while preserving net cash. With a forward PE of 13.3, every dollar of buyback compounds shareholder value at an attractive earnings yield. That is an underappreciated return mechanism for a name often viewed purely as a science story.
The bear case starts with Eylea. Legacy Eylea U.S. sales fell 36% to $473 million, and management explicitly guided sequential declines into Q2. Samsung's biosimilar is currently blocked until January 2027, but additional biosimilars from other manufacturers are expected in the back half of 2026. Eylea HD is converting patients, but the net effect is still a shrinking ophthalmology pool near term.
Second, Dupixent concentration risk. Through the Sanofi collaboration, Dupixent represents roughly 30% of Regeneron's economics. Any unforeseen safety signal, label restriction, or competitive entrant would directly threaten 30 cents of every dollar the company earns. Concentration is a feature of pure-play biotechs, but it is genuine risk that diversified pharma names do not carry to the same degree.
Third, the manufacturing margin guide down. Full-year GAAP gross margin guidance at 77 to 78% versus the 80-plus historical run rate implies a meaningful earnings drag in 2026. The Ireland interruption is described as temporary, but biotech investors know temporary manufacturing issues sometimes become 12 to 18-month overhangs.
Fourth, IRA price negotiation exposure. Older Regeneron drugs are entering Medicare negotiation eligibility windows, and the long-term industry effect of price-set caps remains a multi-year overhang for the entire branded biopharma space. Regeneron is not uniquely exposed, but it is not immune either, and the $700 share price already reflects expectations of orderly outcomes.
Regeneron's natural peer set is large-cap biotech, Vertex, Biogen, Amgen, AstraZeneca, and Gilead. Versus Vertex, Regeneron trades at a meaningful discount on forward PE, 13 versus Vertex in the mid-20s, reflecting Eylea biosimilar concerns offset by Dupixent's strength. Both are pipeline-driven, but Vertex carries cleaner near-term franchise visibility in cystic fibrosis.
Versus Biogen, Regeneron is the cleaner growth story. Biogen carries Aduhelm and Leqembi launch uncertainty in Alzheimer's, plus a declining MS franchise. Regeneron's growth profile through Dupixent is far more de-risked, and the pipeline depth is comparable or better. The market gives Regeneron a richer multiple as a result, even after this week's drawdown.
Amgen is the closest scale comparable. Both run mature franchises facing biosimilar threats while investing heavily in next-gen pipeline. Amgen trades at a similar forward multiple but offers a higher dividend yield. Regeneron offers more aggressive buybacks. The choice between them often comes down to whether you prefer income-style return or per-share earnings compounding through repurchases.
AstraZeneca and Gilead round out the comparison. AstraZeneca offers more global oncology exposure with a richer dividend. Gilead is the value play with HIV franchise stability. Regeneron sits in the middle, a U.S.-centric, founder-led biotech with both growth and capital return optionality. For investors who want science-driven growth without paying small-cap valuation, REGN is the natural slot in a portfolio.
Options activity into the print was elevated. Implied volatility was pricing roughly a 5% earnings move, which underclubbed the eventual move when you include the next-day analyst cut continuation lower. Put-call ratio sat just above 1, modestly bearish positioning, which proved correct directionally despite the EPS beat.
Post-earnings, put open interest concentrated at the 700 and 680 strikes for May and June expirations, which lines up with biosimilar launch hedging activity. Call open interest at the 750 and 800 strikes reflects upside positioning into pipeline catalysts, particularly the Q4 cemdisiran decision and the August garetosmab PDUFA date.
On the institutional side, ownership is north of 88% of float. Vanguard, BlackRock, and Fidelity collectively own a meaningful, single-digit percentage stake. The Capital Group also holds a long-standing position. There has been no notable institutional exit on Q1. The post-earnings selling appears retail and short-term fund-driven rather than long-only repositioning.
Insider activity has been routine. Dr. Schleifer and Dr. Yankopoulos sell shares through pre-scheduled 10b5-1 plans, standard for founder CEOs with multi-decade equity grants. There were no unusual sale clusters in the days surrounding the print, which would be the genuine red flag if it had occurred. Sanofi's continued partnership stake, economics only, not equity, anchors the Dupixent collaboration.
Bottom line on Regeneron, a strong Q1, intact franchise, reasonable valuation. The market punished the margin guide and Wylia visibility, known headwinds, not new ones. Forward PE 13 with a $3 billion buyback is a fair entry.
Hold through the cemdisiran and garetosmab decisions in 2026. New buyers should size with biosimilar timing in mind. Charged alpha rates Regeneron a constructive buy, bear case priced in, bull case not.
Financial data and charts sourced from Financial Modeling Prep. Charged alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.